this is Renee. She's working the camera for us. She's my lovely wife also. And we come out here. Great, right? It's a great husband and wife team, so she helps us out with that a lot. So we come out here to show you guys and tell you guys and give you information about some of the products that we have. What we do life insurance, and that comes in a couple of different versions. Term life, whole life, life insurance for your children. We also do Medicare supplements. Everybody know what Medicare supplements are? Okay, so if you're on Medicare, Medicare will pay 80% of your cost for all of your health needs, but the other 20% is payable by you. So Medicare supplements cover that 20% that Medicare doesn't cover. Or we do Medicare Advantage planning. Once you get out of Medicare, then we put you in a plan that's Medicare Advantage, and then it will pay 100% of all of your costs. So we do Medicare supplements and Medicare Advantage plans. We also do long-term care planning. So long-term care is needed when people get to a point in their lives where they can no longer take care of themselves, and they might need to be in a nursing home, and they want to protect assets. So long-term care is very active for that. But what we want to talk about today is the life insurance. Now, this life insurance comes in two ways. It comes in term life insurance, and it comes in whole life insurance. Now, you guys know the difference between the two? Who can tell me the difference between term life insurance and whole life insurance?
Whole life insurance is for, like, there always.
Exactly. So whole life insurance, just like the young lady said, will take you, say, from the time you're 50 to your 100 years of age. It lasts your whole life, just like it sounds. Term life, on the other hand, will last you for a specific number of years. You can get a term life policy that lasts 10 years, 15 years, 20 years, and sometimes even 30 years. But the policy will eventually expire. So you have 20 years on that, so if you're 50 and you take a 20-year term, it will expire when you're 70 years of age. And at that point, you're going to have to get more coverage again. So term life is designed for short periods of time when you need coverage. Yes, ma'am?
When you get, if you live to get 100, then you have to keep on paying, they gonna reduce the money back to what you done put in.
No. When you get to 100, then the policy matured and down, and you no longer need to make any more payments. It is paid up at that point. So you will get the full face amount. So say you took a $20,000 policy and you live to be 100 years of age. Once you hit that last payment, you will no longer make payments, but the policy will still be enforced and will be considered paid up at that point. And your beneficiary will receive the money whenever you did pass, 101 or 110.
Is it a paid insurance? Can you pay any cash it in?
Yes, you can cash it in. Now what happens when you cash in a life insurance policy? Okay? If you cash a life insurance policy in, then the money you receive is reduced from the face amount. Right? So if you cancel the policy, you'll receive all the cash benefit out of it, but the policy will no longer be in effect. But you can borrow the money out, but it wouldn't reduce the face amount. So when we have a term policy here versus a whole life policy, when we have a term policy, it does one thing. It pays for a death benefit. That can be $50,000, that can be $100,000, it can be $25,000. It can be whatever you like, but it just does that one thing. Yes, ma'am.
And when you, if you get it for 50,000, and then you die, will they give you the money back?
No, they will give you $50,000.
That's what the money is.
That's the coverage amount you're paying for. Just like when you take renter's insurance or homeowner's insurance or car insurance, you pay a small premium, but the cost to repair your house and the cost to repair your car may be much more than that. So you might pay a premium every month that's $50, but something that's several $1,000s may have to happen. You know, so it's designed so that you're paying money every month to ensure that if something does happen, you can take care of it. You ladies have any questions over there?
If you take out the policy today, when will the policy come in effect?
The policy is in effect immediately. Okay? Now we'll talk about that in a second. When you have term life, it does that one thing. It pays a death benefit. When you do whole life, it has two things. It has a death benefit, but it also has cash value that's in it. So whole life policies have a death benefit the same, just like a term life policy, but they also build up cash value over time. There's $1,000 in there, there's $2,000 in there, there's $3,000 in there over time. And over time, you can borrow this money out. But when you borrow it out, if you have a $20,000 policy and you take out $3,000, now the face amount is 17 unless you pay it back. Okay? So the cash here is yours, but if you take out the cash, it reduces the face amount of your death benefit by whatever amount you took out if you don't pay it back.
Can I ask you something?
Yes, you may.
I had been in the insurance about 30-some years or something like that, and I had my son in the insurance.
Mhm.
So, we had 2 or 3 insurance, you know, with the same company.
Yes.
But one of your insurance paid up when he got about certain age.
Mhm.
One of them will pay up the balance of your life. So that's what I'm asking, that's what I'm saying.
Mhm.
It's an insurance like that, I'm talking about what y'all have?
Yeah, we have all kinds of plans. We're a broker, so we represent many different companies. And some of the policies we have are policies that you can take that are paid up. You might pay them for 20 years. And then after 20 years, you make no more payments. It's like owning a house. You've paid it off, you now own it, and you make no more payments, but you're still insured. Something happens, the policy will pay out. Yeah, so that's just how it works right there. So with the whole life, if you borrow money out of it, it reduces the face amount by that amount. And also the good thing about whole life is, once this cash value has built up, if you ever run into any financial difficulties, can't make payments, the money is pulled out of the cash value to make the payment on your premium every month. So it kind of protects you when you have something going on. So that money is there for you to use as you see fit, or it's also there to help pay the premium if something comes up and you can't do it. Okay?
What you mean you can cash more than insurance again? What you mean you can cash more in and get the money? That what you mean?
Yeah, you can cash your policy in and use the cash value for that. The cash value can also be used to pay premiums if you can't make the payment for some reason at some point. So the thing with the term of the whole life is you really have to decide, what is the purpose of your life insurance? Is it to last you a short amount of time, 10, 20 years, or do you want it there when you pass? Is it designed to be there for a beneficiary to take care of your final expenses, burial, pay debt, whatever? So if it's designed and you want it to meet that purpose, then whole life may be a better product. Term life is good for short windows. Yes, ma'am.
Excuse me. But, if you take out a policy like 10 years ago, you want to borrow it, yes, because it's a whole life policy.
Yeah.
How many years do it take before you're able to borrow it again?
About 2 years. So after the first 2 years, the surrender period is over and you can start pulling out that money that you put in. But you can never pull out more than you put into it. So for example, you might have a $20,000 policy, but the cash value might be $2,000. So you're going to be able to pull out whatever the cash value is at that time. So they'll tell you a certain amount of the cash value that is available to you that you can pull out. They send a statement to you every year that lets you know how much is available for you. So you can only pull out what you put in. Yes, ma'am.
Suppose after the 2 years, you decide to pull out everything you don't carry for a month and take it all out, and decided that you want to cancel the policy, can you do it?
Sure, you can do that.
Oh, okay.
So that's just like if you have a house and decide to sell it, once you sell it and get the money, then you're no longer in the house. You no longer have the policy. So if something happens at that point, then you won't be covered. Okay? So the thing to really kind of understand is whole life is kind of designed to be there at the end and to be there through your whole period, and it also has cash value. Term is going to be much cheaper than whole life. Now that's why people are attracted to it a lot, because it's cheaper. Because the insurance companies know if they give you a policy of 50, the likelihood of you living to 70 is very high. So they know the chance of paying out is very low. So they can make these rates much lower. You give somebody a policy and say, listen, it doesn't matter when something happens, you be 100, 90, we're going to pay out. Well, then they know there's going to be a payout on that, so the premiums are going to be greater. Plus, you're funding the cash value. So the premiums on whole life are going to be more expensive than on term life. Because you're doing two things, paying for the death benefit and funding this cash value, and the insurance companies know the likelihood of a payout on a whole life policy is much greater than a term life policy. Okay?
It's older you get, it's the older person get in the insurance, younger insurance day. And the younger person, the older person insurance be higher than the younger person.
Oh yeah, definitely, yeah. Matter of fact, let's take a look at that, how that goes.
I know, I said one day.
So when you're 40 years old, say,
I'm on for age there, 46, 46 or 57.
and say this is the insurance. Now, here's how whole life insurance goes. Whole life insurance goes just like this.
Okay.
It's a straight line all the way, right? So if you started when you're 40, the price will never change. So this is the price,
Okay.
okay? The price is the same the whole time.
Mm-hmm.
When you take a term policy at the same point, the term is going to be cheaper to start, but then it's going to go up. So each time you renew the term, the price is increased.
Mm-hmm.
So over time, you come from here all the way up here with term, and it's more expensive. So this is whole life right here. And whole life will always be the same premium, the same coverage amount, and never change. Term life will always go up. And like you said, when you started when you're younger, the policy is more, is cheaper than when you started when you're older. You start a policy when you're 70 years old, it's going to be much more expensive because the insurance company is saying, well, you don't have much time to pay. Someone that's 40 years old has much longer to pay, and they can make the premium much smaller for them. So what they're doing is looking at the age of 100 and looking at where you are relative to that. Yes, ma'am.
Okay, that's true what you're saying, but we got people flying out here with all kind of age.
Yeah.
And like, so like, I'm just 65, I wanna know how much it would cost for a 65 years old.
Yeah, that's what we're going to do. We're going to go through some prices, but just in general, it's cheaper, when you're younger, as opposed to being older. But we've got companies that have great prices, for young and old. Okay.
They should take that off because people leaving out here young now.
Oh yeah, they do leave young, and anybody can leave at any time. And what insurance companies do, they just go by statistics. Now, if I said I've got a 20-year-old person and I have an 80-year-old person, in the next 10 years, who's most likely to die? Most likely. Okay, right. Not that something can't happen to the 20-year-old, right? But the likelihood is that someone that's 70 or 80 years old, something's going to happen to them. So that's all insurance companies do, is they look at the statistics and see how long people are living from one point to the next, and that's how they gauge the premium, right? Now, life insurance, the cost of it is going to be determined by two things. So the cost is determined by what two things? Your age, exactly, and your health. So people that are younger, like we just said, will have better prices, right? People that are healthy will also have better prices than people that are not healthy, right? So what a life insurance company does is evaluate you based on your age and your health. Say for example, we've got two people once again. One had a stroke 6 months ago, one never had a stroke at all. Who is going to have the cheaper premium?
One never had a stroke.
The one that's never had a stroke, right? So, doesn't mean the person with the stroke can't get the coverage, but just in evaluating them, they're going to say, well, listen, these health issues might raise the premium a little bit more. Or the person with the health issues can get what we call a preferred rate, while the other person might get a standard rate. So these are the factors that kind of impact it. So if you've had major issues, what the insurance company is looking for is time since the issue. So if I talk to someone that had a heart attack 6 weeks ago, well, there's going to be a certain type of policy that we can get them. And that's the next thing we'll talk about here. We'll talk about graded policies versus level policies. And someone asked earlier, when does the policy go into effect? Well, with the graded policy, the policy has a waiting period. And they're designed for people that have had some of these serious health issues. So, if someone had a heart attack, 6 weeks ago, we get them a policy, the insurance company saying, yeah, we'll cover them. However, before we make a full payout on it, they have to be into it for 2 years. Okay? Now, when someone is healthy and they have a level policy, if something happens to them, a week or two from the time they take it, it will pay out whatever the face amount they take is. Now, a graded policy doesn't mean it'll pay zero. Some of them will pay 30% in the first year, 70% in the second year, and then 100% in the third year at the end of year 2. Which means if I had a $20,000 policy and something happened in year 1, it would pay out $6,000 of the $20,000 policy. If it's graded. In year 2, it would pay 70% of the $20,000, so it would pay $14,000 out. And then in year 3, it will pay the full $20,000 policy. So a graded policy is not that bad if your health is not, the best. Now, different graded policies vary. Some will pay 0, 0, 100. They won't pay anything in the first 2 years except the money you put into it plus interest that the government tells you they have to pay you back. So they'll pay you back your money plus 10, 15 to 20% interest. Now, a level policy will pay 100% from day one. You take the policy on Monday, you die Tuesday, the policy will pay out. Because when they evaluated you, they said your health is good enough to warrant a policy with no waiting period. And that's what a level policy does. So a level policy is the one that we always seek of. All the policies we write, 95% of them are level. It's rare that we have to do a graded policy. Because we carry so many different carriers, we'll always have one that is going to look at a situation differently than another. And that's why we carry different companies. Go ahead.
Well, is a level policy higher?
No, the graded policy is actually more expensive because it has higher health risk in it, right? So now, you're the insurance company. You know a person you give a level policy to that's not having any issues, has a pretty good shot of living a long, normal lifespan. But if someone's had recent issues, you think that their lifespan might be a little bit shorter. So a graded policy is going to be more expensive and it's going to have payout. That's going to be different. Now, once you get past year 2, the policy pays 100%. So now you're on the same grade as a level policy. But like I said, this is going to be a small percent of the policies. Most policies with the companies that we have will be level. But we carry them all just to be able to fit different situations. Any questions? Yes.
Yeah. Okay. I have a daughter that I had took a policy out on 25 years ago.
Mhm.
Only $4.98 for $5,000.
Yes, ma'am.
I think I do add it up. Borrow just that policy. Can I cash it in? Or do she have to cash it in?
Who's the owner of the policy? Do you pay for the policy? You own it? Then you can cash it in if you're the owner of the policy.
But it's for her.
It's for your daughter?
Right.
Yeah, so but you're the only one that can cash it in. The owner's the only one that can call the insurance company and say, listen, I'd like to cash this policy in. I'd like to cancel it and receive my cash proceeds.
Let me ask you, can I borrow all that's in there? No.
Yeah, so the insurance company will tell you how much cash is available there, and they'll allow you to pull that amount out. Okay, so they'll definitely do that. And what we'll do is kind of take a look at some prices now to give you some idea. So this is a sheet that has prices, and we'll take a look at some of them so you have a good idea of what the insurance premiums run.
You let go back from the smoke, if you're a smoker or non-smoker.
What do you say? Yeah, the rates will vary from smoking to non-smoking. So we all know about the risk of smoking, so the insurance companies know about that too. So if you smoke, the rates will be slightly higher than if you're non-smoker.
You got trouble with him too?
Yep.
I don't smoke, but.
All right, so everybody, you see that sheet that I just passed out to you? Okay, now let's take a look at this sheet and you can kind of get an idea of what the prices are. So let's go down on that sheet and you see the age 50? Now tell me what the cost will be for a female that's non-tobacco for $25,000, that's age 50. How much?
Hi, everybody doing?
Hi, how are you?
All right.
Have you come in and joined us?
Yes.
Come on in.
Okay.
Find a seat, come on in. That's exactly right, $52.64. So, you see the age in the middle there? Okay, so you see the age right there in the middle. You look at the age is 50, and then the $25,000, the cost is $52.64. So we have a female that's 50 years of age, she's not tobacco, and she's looking for $25,000. We're only talking $52.64. And that's just to give you some ideas. So that's a very good price, and that's a level policy. So that assumes the person is in fairly decent condition. It just means if they've had major issues like heart attack, stroke, cancer, that it's been more than a year ago. So once it's been a year or two, then we can put people into the level policies. So they're looking at time. So that rate can be attained by most people that are 50 years old that would like 25,000. Yes, sir.
In order to work the system, would it be possible for the person knew that these conditions existed prior to actually taking this policy out, that they would wait the limited time before they actually go and purchase that policy?
That could be, yeah. And here's what you run into when you do that, right? So, did everybody kind of understand that question? Did you ladies understand that question, yourself?
No, sir.
Okay, the question was this. Suppose I do have a major issue. Should I just wait and take the policy after the time has passed that will allow me to get a better rate on a policy?
Lower rate.
Exactly. So, and sometimes it works out and sometimes it doesn't. Here's what happens. Like we said, health insurance and life insurance are based on what? Age and health. Well, if something just happened to you and I said, well, listen, we have to give you a graded policy based on your health history because you've had a recent event. Now, if you wait 2 or 3 years, I can get you into this policy, but now that you wait, what's happened to your age?
Going up.
It's going up, right? So maybe you were 50 when that happened, and now we're going to look at doing it when you're 52 or 53. Now the premium is just different. If you started it here, you'll already be past that 2-year waiting period, and the premium will probably be lower than the level policy just because you started it earlier. But it'll depend on the company and the issue. But you can wait, but when you wait, you're also going to look at the time, and your age will increase, and therefore the premium will increase even once we get to that. A graded policy is not bad. Once you have it after 2 years, then it's the same as a level policy, and you've gotten it 2 years earlier. And it will pay out in the interim if something happens, just not the full face amount. After year 1, we have them that pay 70%. That's pretty close to the full face amount. So a $20,000 plan will pay $14,000 out. Everybody can understand that question?
Then
Okay.
I noticed this plan is on a whole life insurance.
Yes.
What would be the price of a term?
Term is going to be cheaper. Term will probably be about half of what you see there for the same amount of coverage. Now, one thing with the term also is, the term is not available in like $10,000 face amounts. So most companies are going to want at least $25,000 for a term policy. Okay? So the minimums are going to be a little bit higher. So you won't have very many term policies that will be 10 or 15 or 20,000. 25 for most companies is the minimum. We might have one, I think, that will do a $10,000 term. So it's available either way, but term is going to generally have a higher limit. But the price will be about half of whole life,
So
right?
that'll be about $26.
Yeah, maybe even a tad lower. Now, here's the thing with term 2.
50, you ain't no 50.
Yeah, but just on that example, right. But here's the thing that term 2. Now, if you're the insurance company and you're going to reduce the price that much, now you're looking for people that you are pretty sure are going to live that next 10, 15, or 20 years. So from people that have had major issues, they say for term insurance. Because now they're cutting the rate down that low, they want you to know, hey, have you had something go on? Yeah, no term. So we can't do term if you've had heart attack, stroke, cancer, insulin-dependent diabetes, but we can do the whole life all day with those issues. Okay?
That's instead of a 6-month period of time, you had it, a year, a period of time. But if you had something 20 years ago.
Then it doesn't matter. They're only looking over the last couple of years.
Okay.
So they're looking at the window in the last 2 years. So 20 years ago, they're not saying, listen, you had some issue, heart attack, stroke 20 years ago. That's not relevant to getting the life insurance today.
Okay.
Only if it's been in the last year or two. And then, like I said, we have policies to take a look at that will still get you a level deal. Now, let's look at another price on there. Let's look at a 55-year-old male that's non-tobacco, that doesn't smoke, and say he wants $20,000. What would the cost for that 55-year-old male be?
65, 25.
Exactly, $65.25. And that's for a 55-year-old male non-tobacco. And that's just once again to give you an idea of what the cost is. So it's very inexpensive. I mean, it's going to cost you some money, but what it does is provide you the kind of coverage you need. Now, let's do one more. What about a 70-year-old female?
Yeah.
Now, who can tell me the price for a 70-year-old female for $10,000? Exactly. So if I've got someone that's 70 years of age, and they just want $10,000, which is going to pay for burial and final expenses, It's just going to cost them $51.33 per month. Now, that's not much at all, and what that's going to do is give them something that gives them some security to know that they can take care of those final expenses. Any questions on those prices? Yes, sir. Question?
Yeah, I was thinking about actuarial science and how they calculate the particular death benefits of individuals and things when they're gonna die. But my question's always been, whenever you look at a chart, the female is lesser than the male.
Yes.
So what's the reason for that?
Why would females be, like, say for example, say you've got a Mercedes-Benz, well, I don't say Mercedes-Benz, say you have a car that has a reputation for being extremely reliable, right? Versus one that breaks down a lot, right? One that's going to have a shorter lifetime. Well, the cost of the warranty is going to be cheaper on the one that's going to have a longer life because they know they'll have less to put into it over the same amount of time. So women live longer than men, therefore their premiums are cheaper. But on the other end,
At the same age.
at the same age, right? So if I have a 55-year-old female, the 55-year-old female will on average live longer than a 55-year-old male. But on health insurance, it's just the opposite, right? So the new healthcare law may change the fact that health insurance rates vary. Ms. Elmer, did you hear what I was saying right there? I was talking about the difference between the health insurance and life insurance. The life insurance rates for women are going to be cheaper, but the health insurance rates for women are more expensive. Because why? Women live longer because they take care of themselves more, right? They go to the doctor when something is going on. They find out what's up, so they use health insurance more, and they pay more for that. And that's why the rates vary. But now with the health insurance law, it's still going to be the same male or female. But the life insurance will vary. Huh?
When will they do it for the insurance if they can do it for the health?
Well, because the fact that's a fact. That men will die, you know, when men live as long as women, then the rates will go to the same. So if the average man lives to be the same as the average woman, then the rates will be exactly the same. You know?
Average.
On
In
average.
the population.
Exactly. So you can kind of see the rates. You kind of see the rates are really not that expensive. And what having this policy does, I mean, what does it really, you know, do for you? You know, so it doesn't do a lot for you right now except give you the comfort that your family doesn't have to be burdened without you having a life insurance. When you don't have it, what happens? So, yes ma'am. Sure.
Do it pay the hospital, compensation? If you.
No, the life insurance pays your beneficiary, whomever you name, when you die. So if you have one of your children, that's what it pays, right? And so what, you know, let's imagine someone here who doesn't have life insurance. They pass, and what happens? We've all seen it, right? Someone died, they don't have life insurance. Now the kids in the family have to go around begging, borrowing, asking people to help them out. Facebook. So,
Donate money.
exactly, they have to ask for donations, and it's a very difficult situation. It's difficult because you haven't kind of prepared and left your family with the right resources to take care of that.
When they burn up, what you call that?
When they,
Burn.
cremation?
Yeah.
Yeah, when you get cremated. And yeah, your relatives can use these funds to bury you or cremate you, whichever you prefer. But when you don't have the life insurance, it creates a burden for your family that has to still take care of those issues. Miss Elman, did you guys hear me over there?
Say that again.
What I was saying was, when you don't have the life insurance, it creates a burden that your family has to deal with in a very difficult time. So like we've seen, they've got to go begging, borrowing, and asking relatives and friends to help them out with that cost. So the benefit of the life insurance is going to be something that you know you've taken care of the business, they can handle it, and when they go talk to the people, listen, my father died about a year ago. And you know, even though I sell the life insurance, I never had a direct experience with it. And I was here in Georgia and had to go back to Philadelphia. And he was in a hospice. And our hospice is calling me every few hours because they want him out of there, right? They don't like bodies laying around. Well, I said, listen, it's going to take me a few days to get up there. And they kept calling me. Well, I called the funeral home and said, listen, can you go get my father? Because they're calling me incessantly about getting him out of there. They said, yeah, we would go get him if we had money, if we knew how we were going to get paid. So I had to go up there and go meet with them. But what I had in my hand when I went up there was what? I had my father's life insurance policy, right? So when I get there and I sit that policy on the table, oh, a whole different attitude comes up there, right? Because now they know it's time to get paid, right? Now I've got the leverage. But suppose I don't have that policy. Suppose my father didn't handle his business. Suppose he never thought about it, never took care of it, everything else came in the way of it, and now I'm standing here, they're looking at me, I'm looking at them, I've got my head down because I know I don't have the resources to take care of that. Now I'm at their mercy. Now a $10,000 funeral is going to cost you $12 because they've got the leverage. They can kind of dictate to you what the terms are going to be. And when they can dictate the terms, it's going to be more expensive.
Okay,
Yes, ma'am.
if you got a $50,000 policy,
Yes, ma'am.
you finna go and bury them, you know? But then it's gonna cost a whole bunch, but then you can get a cremate, that's what it is, cremate. And can you get the other money for you? Or you gotta?
No, yeah, you're a beneficiary. So say you have a $50,000 life insurance policy, and say a funeral costs $10,000. Well, that difference goes to your family member that you've left the money to. So the important thing is, this product is going to make sure your family is not burdened by standing there talking to a funeral director without ammunition to know how they're going to take care of this process. Okay? So that's what it does, and that's what we encourage people to do, is to take a look at that. Now, the other thing we want to show you is another kind of insurance that we do. Yes, ma'am? Go right ahead.
Look, suppose you got insurance on people, they have insurance on themselves and they pass away, but they don't have enough.
Enough to handle. So say, for example, like you said, you have a $5,000 policy and it costs $8,000 to bury someone. Well, the funeral home's going to say, well, listen, you've got 5, where's the other 3 coming from?
Yeah.
So they're going to ask you to reach in your pocket, and once again, you're going to start backtracking and bumping and stumbling, but not you, but your family, your kid. And you know they don't have any money to take care of this stuff. You know dang well these kids, they don't have it. So when you leave that burden on them, that's something they're going to deal with. And say, man, I wish my mom would have gotten me some life insurance. And like I said, I got to see how it worked after selling all these policies when my own father died. Okay? But if you don't have enough coverage, it doesn't change the cost of the funeral. If you go into Macy's and say, look, I'd like to buy that dress. It's $50, I've got $40. They say, see you later. Right? They want the extra 10. They don't take what you have. They're going to want that difference out of you some way. So you're going to have to pull it out of your pocket, or you're going to have to get people to help you out with it. Yes, ma'am.
Okay, this is a serious question. You know, the gas company, the light company take payment arrangements. Are there any, now I don't know if you make, I can speak for all funeral homes across the 50 United States. Do any of them take payment arrangements?
I'm sure some do.
Yes,
But,
they do.
you know, I'm sure some of them do.
Yeah.
But I'm sure many of them don't. Because here's what they know, right? Here's what they know. If people die broke, their people are broke, right? If they didn't take care of this kind of stuff, here's what you can tell about people,
10,
right?
30 years before.
Right. Here's what you can tell about people. If they die and didn't take care of it, you know dang well the kids can't. So you're asking somebody to loan you money when here's the history line that people see. And people judge you on that. And you can make judgments on people because if you didn't take care of it, you didn't teach your kids to take care of it either. Right? So they don't have any money either. So if I'm sitting here now and a funeral costs $10,000, yeah, go ahead. But I can't guarantee I'm going to get paid if I'm the funeral director. I don't have any leverage. You don't have anything I can, do, and I don't want the hassle of getting the money. So while some may, many will not. And even if they did, who wants to leave that to somebody else to handle? I'm so glad my father took care of his business. I'm glad I'm not making payments now to a funeral home to pay for his funeral. Yes.
You know, when you guys don't have a coverage to pay for their funeral, but then it's still, you like you said, taking payments or paying for it, but you still, every place that they owe, you gotta pay that too.
Oh,
Not really.
Yeah.
If they had credit card installments, seniors, credit card.
Yeah, not the individual beneficiary. Now, but the estate that, whatever remains in the estate. So say you had a house, right? And you died and you had a house that was paid off, but you never had any insurance to take care of the debt. Well, the people that you do owe are now going to go put liens against the property. So whomever you pass it on to is going to have to deal with that. You're not going to get anything for nothing. Dying is not going to get rid of debt, right? The debt's just going to go on to whatever you have. The only way it gets rid of it is if you have absolutely nothing to start with. You die penniless, then there's nothing they can get from you. But if you have one piece of paper that they can attach a lien to, believe me, they will do it.
Car.
Okay? You leave a car, a house, any kind of dollar in the bank. Yes, ma'am.
Okay, I'm sitting in here because I'm listening, because I don't have insurance on myself. My 4 kids have insurance on me.
Yes, ma'am.
Because I'm on a fixed income.
Yes.
But what I'm sitting in here for, I wanna leave something for my grandkids.
Exactly.
I don't wanna leave nothing for the children, because they'll already tell me, Mama, each one of us have our own insurance on you.
Right, right.
And you don't have to worry about that because you're on fixed income.
Right.
But like I say, for the grandkids,
Yes,
that's why I'm sitting in here.
perfect. And that is a very good reason. And that's one of the things we're going to talk about here too now. The life insurance, is, of course, is not about you, it's about other people. And these other people are the people that you love, and this money can benefit them. This is a plan. How many of you here have grandchildren? Okay. Almost everyone, right? This is a plan we call Head Start, and that was a good lead into it. And what this plan talks about is life insurance for children. So you can take a policy on yourself that will benefit your grandchildren or your children. And you can also get coverage on them. And so that if they ever need it, the coverage will be there for them.
Can you put the insurance on money? If you have a lot of money, can you put insurance on your money?
Get insurance on your money?
Uh-huh.
Yeah, the bank has FDIC insurance. So
They have.
yeah, so when you put your money in the bank, what it does is ensure that if anything were to happen to it of $200,000,
Okay,
your money's all good, it's protected.
okay.
So you can insure your money by just having it in a bank.
Uh-huh.
All right, so federal deposit insurance is insurance provided by the government in case banks fail or something else happens in the financial system. Now, you see this sheet right here, Head Start. What this sheet talks about is life insurance for your children. And it does exactly what you just mentioned. You can have a policy on yourself that will pay a benefit for your grandkids, and you can set that up and divide it up how you like. So say, for example, you have a $25,000 policy and you have 5 grandkids, and you want to leave them each something. We can list each one of them out separately and have $5,000 go to each of them. And we can make all kinds of arrangements, you know, to have it paid out at certain ages and do estate planning and that kind of thing. Yes, ma'am?
That's if you got to live with.
Yeah, that's what I'm saying. We can set all that up.
You got to
Exactly.
get a power of attorney for a living will.
And that's one of the things I was about to talk about here. One of the companies we deals with, they will do a free will for you once the policy is done. And all of the estate planning and the process that needs to be done for that will be taken care of for you free of charge, and that's set up with an attorney in the area. But what I wanted to show you here.
I can hear.
Mm-hmm.
I can't hear.
Oh, you can't hear me? Hold on 1 second so everyone can hear. Now, what this sheet talks about is this program Head Start. It's life insurance for your children, and it's designed for young people. And what we're doing here is giving you some idea of the rates and how this money can be used. So you see down here right next to the rate chart, it says cash value. And we talked about cash value with the other policy before, but you see also how the cash value can be used. People get married, college tuition. All of these kids today, in order to get ahead, they want to go to college, and it's super important they need to. One thing, when you fund a life insurance policy when they're very young, the cash value buildup can be pulled out at any time, at the time of college, when it's time to get married, when it's time to have kids. It can be pulled out for your use, for their use, to help give them a head start in that next chapter, that next phase of life that they're about to enter. So that's why it's so important. The death benefit is there in case something happens, but it's the cash value that can do so much for them and give them that head start as they move through life. And you see some of the premiums. So, say for example, you got a 5-year-old, and you have a 5-year-old that gets $10,000 of coverage. What does that cost per month? $4.80. All right, so we're talking less than $5. Right? And then when they get the coverage at that age, what are they not doing? They're not sitting here at 40, 50, 60 years old wondering about life insurance, right? Because they've got it. We've got plans that are paid up, which means pay for the plan for just 20 years. So he's 5 years old, and 25, the policy is done. He owns it, or she owns it, and there's no need to take out any more life insurance, and that part of the life is just done. That's one thing they've got checked off the list and never have to worry about again, and that's because you helped them with it. You know it when you're 25, who's thinking about life insurance? No, right? But of course, like we said earlier, the younger you started, the cheaper it is. That's why you see what the cost is. I mean, even look at a 25-year-old. You see at the bottom.
I got 7 grandkids, and the youngest one is 18 years old.
Exactly.
Out of 7.
So look at the 20 to 25-year-old, and look at $10,000 for that. That's just $8.
I'm gonna get them.
$8 for a 25-year-old. Okay, so you're talking $8. I mean, we can all afford $8 to take care of something that important, right? So that's giving you some idea of what the prices are for the kids and the grandkids. And like we said, we know that they're not thinking about that. We know their parents are not probably thinking about that. We know that we're thinking about it for them. And that's part of what we can do to kind of help them prepare as they move through life. Yes, ma'am.
Okay, you said we all can afford $8, okay? I got 16 grandchildren.
Yeah,
Over half of them is 24 to 25.
perfect. That's 16 times 8.
I ain't saying that kind of money, but nobody on that.
Now, I just said everybody can afford 16 times 8. I said everybody can afford 8. Right? So,
First of all, a lot of people say that people our age get too much. We're getting money.
you're not getting a lot of money. And we understand that. That's why we go out and find the cheapest companies that have the best prices and that are very reputable. Now, I didn't say everybody can afford 16 times 8, but I know everybody can afford 8 or 4 or 5, and don't tell me that you can't. Because I know that. Because I look at all of us and know what we do. Yes, ma'am.
If you take out the policy now, say, and the period gotta be, it's a 20-year down, is what we call it. 20 years. And then at 17 years, something happened. But they said, well, I'll just get the money now.
Yeah.
They won't give you all the money.
Well, yeah, they'll give you what's available at that point. And if it's that long, there's a significant amount of cash value there. Yeah.
If the child have lived longer than the policy, and they're not dead now, they still living, but you still can't, they won't give you the full amount until the child dies, the person is dead.
Right, they won't give you the face amount until the person dies.
You done had it for 20 years.
Yeah, so say you have a policy for 20 years, and it's a whole life policy, right? Now, in 20 years, it always is a $20,000 policy, so that in the event of your death, it pays $20,000. But there's also cash value that's with it. The cash value might be $8,000, $9,000, $10,000. That's the part you can pull out. The death benefit is not what you can pull out, it's what's paid out when death occurs. The cash value reflects what you put into it. And that's what you can pull back out. Yes, ma'am.
But is this policy, is the policy on me or on the kids?
On the kids.
And so I have to take out the policy on each one of them?
You have to take out a policy on each one of them. Correct.
That's what I was telling you, you got 16.
I gotta take 7 policies.
Right. So say you had 7 policies at $7 a piece. That would be $49, almost $50 a month, but you would be covering 7 people. Okay? And it's a very simplified issue, so we don't even need to see the kids. All we need to do is sign them up for you.
And then that's not according to just taking the policy out, that's according to how much you want the policy, the value, like you want 20,000, 30,000, 40,000.
Exactly, and you can see on that sheet what the cost is for different face amounts.
So if she took it out and you want $30,000 on each kid, and you got 7 of them, baby.
It's like you say, you take out what you can do, right? If you can't afford $30,000, you take out $10,000, you take out 20. You take out what you can afford.
And make all your money. Well, if that's the case, I'll take out a whole life insurance on myself, which is $49, $49. It'll be $40, so I can just make each one of them 7 kids.
Right.
So I beneficiaries.
Yeah, split it up. You can split it up among them.
My baby going to 42-year-old.
Yes, ma'am.
So You had it on that board, about how much?
For a 42-year-old female?
Uh-huh.
Oh, very inexpensive. Very inexpensive. Now, this sheet that I passed out to you. Mhm.
For 42-year-old?
Yeah, 42-year-old female in good health. I mean, you're talking anywhere from 10 to 20, $30 a month, all depending on how much coverage you want. But it's very inexpensive at that age if you're in
That's
good
not
health.
bad.
Not bad at all. And I'll get you some good numbers for that. Now, you see this last sheet that we just passed out here? This just talks about our rewards program. So what happens is every time you tell us about somebody that we end up meeting with about the life insurance, whether we write a policy on them or not, we give you a $25 referral fee in the form of a gift card to either Target or Walmart. So you can choose which card you want. And all we have to do is sit down, talk with your daughter, for example, and then we end up giving you a gift card. And so that's our way of saying thank you when you help us do business by referring people to us. So that's what we offer for that. So take the time and write down anybody that you can think of beyond yourself. And then we'll call the person, sit down and meet with them, and then we'll go ahead and do something with them. Anybody have any other questions?
Do I have to sign up for that? Or do I have to sign up for that? Could I sign up in March?
Yeah, you can sign up whenever you're ready. Just make sure you don't have a birthday in between. Okay? Because
My birthday don't pay.
yeah, so because you know the prices go up on your birthday. But yeah, you can sign up in February, you can sign up in March. And here, let me tell you how these programs work. When we meet, you don't pay any money on the spot, right? What they do is they draft the money out of your account or off your card on the same day every month. So say, for example, I have a lot of my clients, their money comes in on what day? The 3rd. Okay, so they say, listen, I want that money pulled out on the 3rd or the 4th or the 5th, and that's when the first payment comes out, and it'll come out on that same day every month thereafter. So I might meet with someone today, and they may say, make it come out February 3rd, make it come out the 5th, make it come out March 3rd, and so we can set it up to have it do that for you. Okay? Any other questions? All right, now, I've left those cards on your desk there at the table, and we just need you to fill out your name and everything, and we just ask you, based on what you've heard now, you've seen prices, you understand how some of the plans work, how much coverage do you think you would need based on what you see for the prices there? You're welcome, ma'am. So take a moment,
What's the average cost in Georgia of a funeral?
about $7,000 to $8,000.
Most states is the same, at least I've seen it.
You know,
It may vary a
it
little.
varies a little bit. You know, states have different opening and closing costs. Some have different requirements. In northern states, they want you to dig down into the ground deeper, and some states don't allow you to stack more than one on top of another. Some do. Yeah. So, based on the topology of where they're located, how water affects the land, they don't want it to go too deep, or they want it to go deeper one way or the other. So sometimes these costs vary from state to state, and that's just one of the things that it varies about. So take a moment, fill out the card, you've heard the information, you've got the prices, just give me some idea of how much coverage you'd be looking for. And then Renara and I are going to come by and talk to each of you about it and answer any more questions and see what the best day and time for you is.